Stop what you're doing right now, this second. Put the phone down. Sit up straight. Close the other tab. Stop scrolling. Yes, you stop pretending you're listening while doing something else. Because if you miss the next few minutes, you are going to regret it. Financially, emotionally, permanently. Take a breath, lock the door, turn the volume up, and if you're waiting for that text back, she will never match you back. Focus. Are we clear? Good. Because if you own silver, do not sell a single ounce, do not panic, do not listen to your broker, and do not make a move until after you finish this video. Not one move, not one decision, not one emotional reaction. What I'm about to show you does not show up on CNBC. It does not show up on Bloomberg. And it absolutely does not show up in your retirement statement, but it does show up in the data, in the numbers, in the physical market. Ladies and gentlemen, this is Paper to Atoms. It is 27 Jan 2026. And I'm about to tell you something that should not be happening in a functioning global market, but is happening anyway. Yesterday, 26 Jan 2026, we talked about something that most people brushed off as noise. We talked about the silver supply deficit. We talked about the disconnect between paper contracts and physical delivery. We talked about the pressure building quietly in places most Western investors never look. We talked about Shanghai. We talked about India. We talked about industrial demand quietly draining inventories faster than anyone expected. And I told you that if the pressure continued for just one more trading session, something would snap. I told you that the paper market could not keep pretending the metal was still there if the physical market kept screaming that it was not. And you know what happened? It snapped, not loudly, not with headlines, not with a circuit breaker, but with something far more dangerous, confirmation. Overnight, while Western markets were sleeping, premiums in Asia moved again. Not down, not sideways, up. Physical silver in Shanghai traded at a level that made absolutely no sense relative to COMEX spot. India followed within hours. Then refiners started quietly pulling back offers. Then industrial buyers stopped negotiating. And this morning, the paper price did what it always does in these moments. It hesitated. It froze. It tried to pretend nothing was wrong. But the physical market did not. Yesterday was the warning shot. Today is the escalation. Because today, the spread is wider. The delivery times are longer. The excuses are thinner. And the people who actually need silver, not traders, not speculators, not hedge funds, but manufacturers, are paying whatever it takes. This is no longer a theory. This is no longer a projection. This is no longer a sometime in the future problem. This is a real-time stress test of the silver market, and it is failing in slow motion. And that brings us to today, because what you are about to see next explains why silver at $200 by the end of 2026 is no longer a bold prediction, but a mathematical consequence. Here is the thesis, and I want you to listen very carefully. The same silver, the same purity, the same metal is trading at 3 different prices depending on where you are in the world. As of this morning, COMEX spot silver is sitting near $28.40. At the exact same moment, physical silver in Shanghai is clearing the equivalent of $34.10 per ounce. In India, large wholesale bars are changing hands north of $36,000 an ounce once taxes and premiums are factored in. Let me say that again. The same silver, the same metal, the same atomic structure, separated by $7 to $8 per ounce. In a functioning market, this is impossible. Arbitrage should close that gap instantly. Buy where it is cheap, sell where it is expensive, metal flows, prices converge, end of story. But that is not what is happening. And that is the point. The gap is not closing because the metal is not moving. The contracts are moving. The promises are moving. The paper is moving. But the silver is not. And that tells you everything you need to know. Because if arbitrage were functioning, those spreads would be measured in cents, not dollars. They would last minutes, not days. They would be invisible to the public. Instead, they are widening. And I'm going to prove this to you with numbers, with data, with evidence that even the most skeptical person cannot deny. No hype, no feelings, just math. So buckle up, focus. Let me show you exactly what happened, starting with the numbers they hope you never actually compare. Let me start with the numbers because numbers do not lie. Politicians lie, bankers lie, the media lies, but mathematics is truth. Let's go step by step slowly so nobody can accuse this of being hype or exaggeration. Yesterday, COMEX spot silver closed at $28.12 per ounce. Not futures in some distant month, spot. Right now, cash equivalent. That is the number you see on your screen. That is the number CNBC flashes. That is the number your broker quotes when they tell you silver isn't doing anything. Now let's look at today. As of this morning, 27 Jan 2026, COMEX spot, silver traded as low as $28.05 before bouncing slightly to $28.40. Flat, boring, dead. According to the paper market, nothing is happening. Now here is where it gets interesting. At the exact same time COMEX was yawning, silver on the Shanghai Futures Exchange was trading at the yuan equivalent of $34.10 per ounce. Not a rumor, not an estimate, a cleared transaction. Physical linked pricing. Metal that can actually be delivered. That is a 570 spread. Let me say that again so it sinks in. $5.70 per ounce. That is not noise. That is not currency fluctuation. That is not transportation cost. That is a structural failure. Now let's layer in India, because India is where silver goes to disappear. India imported over 7,800 metric tons of silver last year alone, and that demand has not slowed, it has accelerated. In Mumbai this morning, wholesale 30-kilogram bars were transacting at an all-in equivalent of 36.05 per ounce. That includes import duties, GST, and dealer premium. So now let's do the math. COMEX, $28.40, Shanghai, $34.10. India, 36.05. From COMEX to Shanghai, silver is trading at a 20.1% premium. From COMEX to India, silver is trading at a 26.9% premium. In a normal market, a 2% spread would trigger arbitrage desks to flood the trade. A 5% spread would be closed within hours. A 10% spread would be a once-in-a-decade event. We are sitting near 30%, and it is not closing. Now let me show you why this is catastrophic. Let's go back 1 year, January 2025. COMEX silver averaged $23.80, Shanghai averaged $24.30, India cleared near $25.10. The spread was 50 cents to $1. Normal, healthy, boring. Fast forward to today. The price has risen, yes, but the spread has exploded. Not doubled, not tripled, exploded. That tells us 3 things, and all 3 matter. 1, physical demand has happened. 2, inventory has been drained. 3, paper supply has not adjusted. Let me put this in context. Registered silver on the COMEX, metal available for delivery, now sits just above 27 million ounces. That sounds like a lot until you realize that annual global silver demand exceeds 1.2 billion ounces. That is barely 8 days of global demand. 8 days, and that is before we even talk about industrial usage. Solar alone is now consuming over 180 million ounces per year. EVs, electronics, medical applications, defense systems, all competing for the same shrinking pool of metal. And while that is happening, paper contracts continue to trade as if silver is infinite. Here is the triplet you need to understand. Inventories have fallen. Premiums have risen. Spreads have widened. That combination does not happen in a stable market. Now let me hit you with the most important number of all, the gold to silver ratio. Gold today is trading near $2,350. Silver at $28.40 puts the ratio at roughly 82 to 1. Historically, during periods of monetary stress, that ratio does not widen. It collapses. In 1980, it hit 16 to 1. In 2011, it fell below 32 to 1. If gold stays where it is and silver merely reverts to a conservative 40 to 1 ratio, you are looking at silver north of 58, and that assumes no supply shock. But we already have one, because spreads like this only exist when one thing has happened, one thing is happening, and one thing is about to happen. The metal has left the building. The paper market is pretending it has not, and eventually mathematics will enforce reality. But that is not even the worst part, because when you zoom out and compare this moment to history, you realize something chilling. We have seen stress before, we have seen volatility before, we have seen manipulation before, but we have never seen this combination, and that is why what is happening right now is unprecedented. Now, let me put this in perspective, because I do not want you to think I'm exaggerating. I do not want you to think this is just another YouTube headline. And I definitely do not want you to think we have seen this before, because we have not like this. Let's go back in time. 1973. The end of Bretton Woods was still rippling through the system. Inflation was exploding, silver moved, but the paper market was tiny. Physical delivery still mattered. Arbitrage still functioned. 1980. The Hunt brothers tried to corner silver. Prices went vertical. The exchanges panicked. Rules were changed mid-game. But here's the key point. There was metal. The system broke because demand overwhelmed it quickly, not because it had been quietly hollowed out for decades. 2008. The financial crisis. Everything crashed. Silver collapsed, then rebounded violently. But again, inventories existed. The spread between paper and physical widened briefly, then snapped back. Arbitrage worked. Painfully, but it worked. 2011. Silver Sunday. Prices ran to nearly $50, margin hikes, forced liquidations, blatant manipulation. But once more, this matters. The physical market was still tethered to the paper market. Premiums rose, yes, but the gap did not stay open. Now compare all of that to today. In a normal market, arbitrage is the glue. It is the mechanism that keeps prices honest. If silver is cheaper in New York than Shanghai, traders buy in New York, ship to Shanghai, and sell. Easy money, low risk. That pressure closes the gap. But today, the arbitrage is dead. Not difficult, not expensive, dead. Ask yourself, can we not ship silver from New York to Shanghai? Of course we can. So that is not the problem. Can we not refine it? Of course we can. So that is not the problem. Can we not insure it? Of course we can. So that is not the problem. So what is the problem? The problem is that the silver you are buying on COMEX is not available to be shipped. It exists as a contract, as a promise, as a settlement option, not as a bar with a serial number ready to move. That is why the spread persists. That is why it widens instead of closes. That is why premiums do not fall when paper prices fall. And this is the part that should make you sit back in your chair. We are witnessing something that did not exist in 1973, 1980, 2008, or 2011. A market where price discovery happens in paper, but supply discovery happens in physical, and the two no longer talk to each other. That is unprecedented. Add to that a structural supply deficit, where global mine production cannot meet industrial demand, and you get a system that does not correct. It fractures. This is not volatility. This is not speculation. This is not a bubble. This is a failure of the pricing mechanism itself, and when that happens, someone always steps in to try to stop it, to cap it, to control it. Which brings us to the most important question of all. Who tried to stop this, and what did they do when it started getting out of control? Now, let me tell you what happened yesterday that makes today's move even more significant. And once you see this, you will understand why the reaction you are seeing in the physical market is not panic. It is recognition. Because when a market starts to break, the villains always make the same move. They change the rules. Late yesterday afternoon, while most retail traders were distracted and most Western investors were already checked out, the CME quietly adjusted margin requirements on silver contracts. Not dramatically, not enough to trigger headlines, just enough to send a message. They did this specifically to cool speculation. They did this specifically to force weak hands out. They did this specifically to protect the banks who are short. And make no mistake about this, the short side of the silver market is still dominated by the usual suspects. JP Morgan, HSBC, Bank of America, the same names, the same playbook, the same desperation. Margin hikes are not neutral, they are weapons. When you raise margins, you increase the cost of holding a long position. That forces leveraged traders to sell, it creates artificial pressure, it pushes the paper price down, and for about 6 to 8 hours, it looked like it might work. Silver dipped, volume spiked, talking heads nodded and said, "See? Nothing to worry about." But then something happened. The physical market did not follow. Instead of premiums falling, they rose. Instead of offers increasing, they disappeared. Instead of buyers backing off, they stepped in harder. This is the nightmare scenario for the manipulators, because margin hikes only work when physical supply exists. They only work when paper selling can shake metal loose. They only work when fear creates liquidity. That did not happen, and we have seen this movie before. Silver Sunday, 2011. The CME raised margins 5 times in 9 days. Prices collapsed on paper, but physical silver vanished. Coin shops went dark. Delivery delays stretched into months. The difference today? Inventories are already gone. Back then, margin hikes bought time. Today, they expose weakness. Because the banks are not fighting speculators anymore. They are fighting industrial users. They are fighting sovereign buyers. They are fighting entities that do not care about margin requirements because they are not leveraged. They are desperate for supply. And this is the key insight you need to understand. They can smash the paper price all they want. They can flood the screen with red candles. They can pretend control still exists, but they cannot create silver. And when manipulation fails to produce metal, the next phase always begins. The market looks calm. The headlines stay quiet. And then, suddenly, price resets upward in violent, discontinuous moves. That is why what you are seeing right now is not the end of the story. It is the signal that control is slipping. And once you zoom out and look beyond the West, you realize this is not isolated. It is not local. It is not temporary. Because silver is exploding globally. Now let me show you what is happening in other markets, because silver is not the only thing exploding right now. And this is where the story gets bigger, darker, and far more dangerous for the paper system. Let's start in Shanghai, because Shanghai is where reality shows up first. In Shanghai, physical silver demand has not just increased, it has become price insensitive. Buyers are no longer asking, "What's the price?" They are asking, "Do you have it?" That is a critical shift. When buyers stop negotiating and start securing, the market has already changed. Premiums in Shanghai are now consistently above 20% over COMEX, and those premiums are not attracting metal from the West. That tells you everything. The flow has reversed. Now move west to India. In India, silver is not a trade. It is savings, it is collateral, it is insurance. And when Indian buyers start paying $36, $37, even $38 per ounce without hesitation, it tells you demand is not speculative, it is defensive. And here's the part Western investors miss. India is not buying futures. India is not buying ETFs. India is buying bars, coins, and door, metal that leaves the market and does not come back. Now look at gold, because gold always moves first. But silver moves harder. Gold is holding above $2,300 despite rising rates, a strong dollar narrative, and constant bearish commentary. That alone should tell you something is wrong with the official story. In a normal environment, gold should be collapsing. But it is not. Because central banks are buying, quietly, relentlessly. China has added gold reserves for consecutive months. Russia is settling trade outside the dollar. The East is accumulating while the West is distracted. Now, look at the bond market. Yields are volatile. Liquidity is thin. Auctions are shaky. Foreign buyers are stepping back. And when confidence in sovereign debt weakens, money looks for something with no counterparty risk. That something is metal. Now add industrial buyers. Companies like Tesla, Samsung, and major solar manufacturers do not care about COMEX spot. They care about supply continuity. Missed deliveries cost more than higher prices. And they are already locking in long-term contracts at prices that make today's spot price look irrelevant. This is the part that should make your stomach drop. Because when sovereign buyers, industrial buyers, and Eastern markets all move in the same direction at the same time, the paper market does not lead anymore. It follows violently, late. And while all of this is happening, the public is being shown a number on a screen and told everything is fine, which brings us to the biggest lie in the entire system, the trap, the number you see versus the value you can actually touch. Now let me tell you about the $28 trap, because that is exactly what this is. We need to talk about the difference between the number on your monitor and the real value of the metal in your hand, and once you see it, you will never look at spot price the same way again. Here is the lie. They tell you silver is $28.40. That number is broadcast, repeated, reinforced, anchored into your mind. It feels official, it feels authoritative, it feels real, but it is not. That number represents the price of a paper promise, traded between financial institutions that have no intention of taking delivery. It is a derivative of a derivative of a derivative. It is a betting line. Now let me challenge you, pick up your phone right now, call your local bullion dealer, ask them to sell you 1,000 ounces of silver for $28.40 an ounce. They will laugh at you. Not politely, not nervously. They will laugh because that price does not exist in the physical world anymore. They will quote you $34 or $35, or they will say, we don't have any. And this is where it gets really interesting. Premiums are not just extra costs. Premiums are signals. They tell you where the real market is clearing when paper pricing fails. When premiums are small, paper and physical are connected. When premiums rise, stress is building. When premiums stay high, even as paper prices fall, the connection is breaking. That is what is happening right now. This is the decoupling. This is the moment where the paper market and the physical market snap apart. And once that happens, the paper price becomes meaningless. It can go down, it can go sideways, it can even crash. But physical silver will not follow. Because you cannot settle an industrial contract with an ETF share, you cannot manufacture a solar panel with a futures contract, you cannot secure a supply chain with a screen price, only metal counts. This is why ETFs like SLV are so dangerous in moments like this. They give you exposure to price, but not to availability. They give you liquidity, but not protection. They give you confidence, right up until the moment delivery is questioned. And here is the part they do not want you to understand. Once the public realizes the spot price is a fiction, confidence collapses fast. Not gradually, not politely, all at once. People stop selling, dealers stop quoting. And price jumps in gaps, not steps. That is how silver moves from $30 to $50 without trading at $35 for very long. That is how it moves from $50 to $100 without warning. The trap is thinking you still have time because the screen price looks calm. You do not, because the screen price is the last thing to change. And that brings us to the most important question of all. What does this mean for you right now? So what does this mean for you? What should you do right now? Let me be very clear, because this is the part where emotion takes over. This is the part where fear makes people do the exact wrong thing at the exact wrong time. And that is how they win. That is how the banks cover their shorts. That is how weak hands get shaken out while the strong hands get rewarded. Let me break this into 4 groups. 1. If you own physical silver, coins, bars, rounds, Do not sell. Do not even think about selling. Not because I said so, not because YouTube said so, because the market itself is screaming at you that physical metal is becoming harder to source, harder to move, and harder to replace. Ask yourself a simple question. If you sold today, could you buy the same amount back tomorrow at the same price? No, you could not. The supply is drained. The inventories are collapsing. The premiums are exploding. Once that physical leaves your hand, you may never get it back without paying dramatically more. They want your metal. That is why the paper price gets smashed at 2 a.m. That is why the headlines say silver crashed. That is why sentiment is manipulated to scare you, to shake you out, to make you surrender real wealth for digital illusion. Do not fall for it. 2. If you own silver ETFs like SLV or PSLV, you need to seriously consider your risk. I am not saying panic. I am not saying dump everything tomorrow morning. I am saying understand what you actually own. You do not own coins. You do not own bars in your hand. You own a claim, a promise, a line in a system that is now under stress. In a normal market, that distinction does not matter much. But this is not a normal market. This is a decoupling event. This is where paper contracts and physical supply begin to diverge in ways that are unprecedented. If the squeeze intensifies, if delivery demands surge, if trust breaks, what happens to paper claims? Do they settle in metal or in cash? That is the question you need to ask yourself, and you need to answer it before the crowd does. 3. If you own silver futures, you need to decide right now whether you trust the exchange to deliver. Because futures contracts are not designed for everyone to stand for delivery at the same time. They are designed for rollover, for cash settlement, for speculation. But what happens when traders stop playing the game and start asking for metal? We saw glimpses of this before. We saw rule changes. We saw margin hikes. We saw force majeure whispers. The system protects itself first. The exchange survives first. The banks survive first. Where do you rank on that list? If your plan depends on taking delivery in a crisis, you need to understand the rules can change overnight. They have before, they will again. 4. If you do not own any silver and you're thinking about buying, the question is not, should I buy? The question is, can I still buy? Because we are entering the phase where availability matters more than price, where product disappears, where dealers say, sorry, we're out, where delivery times stretch from days to weeks to months. You are not competing with other retail buyers anymore. You are competing with mints, refineries, sovereign buyers, industrial giants who do not care if silver is $30, $40, or $80, because they need it to keep factories running. That window does not stay open forever. This is not financial advice. I am not telling you what to do with your money, but I am telling you what I see. And what I see is a market where physical holders are in the strongest position they have been in decades. Paper holders are in the most uncertain position they have ever been, and people sitting on the sidelines are running out of time to get in at all. But that is not even the biggest shift coming. So what does this mean for you? What should you do right now? Let me be very clear, because this is the part where emotion takes over. This is the part where fear makes people do the exact wrong thing at the exact wrong time. And that is how they win. That is how the banks cover their shorts. That is how weak hands get shaken out while the strong hands get rewarded. Let me break this into 4 groups. 1. If you own physical silver, coins, bars, rounds, do not sell. Do not even think about selling. Not because I said so. Not because YouTube said so. Because the market itself is screaming at you that physical metal is becoming harder to source, harder to move, and harder to replace. Ask yourself a simple question. If you sold today, could you buy the same amount back tomorrow at the same price? No, you could not. The supply is drained. The inventories are collapsing. The premiums are exploding. Once that physical leaves your hand, you may never get it back without paying dramatically more. They want your metal. That is why the paper price gets smashed at 2 a.m. That is why the headlines say silver crashed. That is why sentiment is manipulated, to scare you, to shake you out, to make you surrender real wealth for digital illusion. Do not fall for it. 2. If you own silver ETFs like SLV or PSLV, you need to seriously consider your risk. I am not saying panic. I am not saying dump everything tomorrow morning. I am saying understand what you actually own. You do not own coins. You do not own bars in your hand. You own a claim, a promise, a line in a system that is now under stress. In a normal market, that distinction does not matter much. But this is not a normal market. This is a decoupling event. This is where paper contracts and physical supply begin to diverge in ways that are unprecedented. If the squeeze intensifies, if delivery demands surge, if trust breaks, what happens to paper claims? Do they settle in metal or in cash? That is the question you need to ask yourself, and you need to answer it before the crowd does. 3. If you own silver futures, You need to decide right now whether you trust the exchange to deliver, because futures contracts are not designed for everyone to stand for delivery at the same time. They are designed for rollover, for cash settlement, for speculation. But what happens when traders stop playing the game and start asking for metal? We saw glimpses of this before. We saw rule changes. We saw margin hikes. We saw force majeure, whispers. The system protects itself first. The exchange survives first. The banks survive first. Where do you rank on that list? If your plan depends on taking delivery in a crisis, you need to understand the rules can change overnight. They have before. They will again. 4. If you do not own any silver and you're thinking about buying, the question is not, should I buy? The question is, can I still buy? Because we are entering the phase where availability matters more than price, where product disappears, where dealers say, sorry, we're out, where delivery times stretch from days to weeks to months. You are not competing with other retail buyers anymore. You are competing with mints, refineries, sovereign buyers, industrial giants who do not care if silver is $30, $40, or $80, because they need it to keep factories running. That window does not stay open forever. This is not financial advice. I am not telling you what to do with your money, but I am telling you what I see. And what I see is a market where physical holders are in the strongest position they have been in decades. Paper holders are in the most uncertain position they have ever been. And people sitting on the sidelines are running out of time to get in at all. But that is not even the biggest shift coming. Now let me address the elephant in the room. Everyone watching this is thinking the same thing. Okay, so how does this actually play out? What happens next? Because markets do not just explode in one straight line. They move in phases, they move in waves, they move in psychological breaking points, and we are now entering the final countdown. Let me map this out for you. Phase 1, the last train, right now. This is the phase we are in today. Spot prices still look normal to the average person. The headlines are still confused. The mainstream media is still asleep. The banks are still pretending everything is under control. But underneath the surface, inventories are being drained. Physical is being pulled off the market. Premiums are rising quietly. Delivery times are stretching. Large buyers are locking in supply behind the scenes. This is the last moment where silver is available before it is obviously unavailable. This is where the smart money moves before the crowd realizes there is a crowd. And here is the key insight you need to understand. During phase 1, price does not tell the truth. Availability tells the truth. Phase 2, the void, the shock period. Then comes the void. This is where something breaks. Maybe it is a delivery failure. Maybe it is a major default. Maybe it is a rule change so aggressive that confidence cracks overnight. Trading halts. Exchanges raise margins again. Volatility explodes. Liquidity vanishes. Dealers pull product from websites. Quotes disappear. Prices gap violently up and down. And for a brief period, nobody knows what the real price of silver is. This is the moment when paper holders feel trapped. This is the moment when people realize that a number on a screen is not the same thing as metal in your hand. Fear spikes. Confusion spikes. Demand spikes. Supply does not. Phase 3. Silvergeddon, the repricing event. Then comes the event, the repricing. The moment when the market stops pretending silver is just another commodity and starts pricing it as a strategic asset, a monetary metal, and an industrial necessity all at once. This is where $40 gets left behind. This is where $50 becomes the new floor. This is where the move toward $100 and beyond stops sounding crazy and starts sounding late. Analysts who ignored silver for a decade suddenly rush to revise targets. Banks that suppress the price start publishing bullish reports. Financial media calls it unexpected. It will not be unexpected. It will be inevitable, because this is not a normal market cycle. This is a paradigm shift. A supply-constrained, demand-exploding, trust-breaking repricing of one of the most manipulated assets on Earth. And the timeline? It is not measured in decades anymore. It is measured in months, possibly weeks once Phase 2 begins. But here is the part they never tell you, ever. The biggest gains happen not when everyone is excited, but when almost no one believes it is coming. So here is my final message to you. The silver market is not behaving normally. The spreads are widening. The physical supply is tightening. The paper system is showing stress fractures that are getting bigger by the week, not smaller. We are watching the same pattern that preceded every major precious metals repricing event in modern history. Only this time the industrial demand is larger, the global debt is higher, and trust in financial institutions is lower than ever before. The time for debate is over. The time for watching is over. The paper market is dying. The physical market is taking over. For years, stackers were mocked, dismissed, called conspiracy theorists, and yet here we are. Inventories drained, delivery pressure rising, and the very institutions that laughed now scrambling to secure supply. You are not late, but you are not early anymore either. You are holding the collateral of a system that is being repriced in real time. You are holding insurance against monetary instability. You are holding an asset that governments cannot print, banks cannot fabricate, and algorithms cannot create out of thin air. Do not sell. Do not let them steal your metal. Do not let them shake you out with paper volatility while the real market tightens behind the scenes. The target is 200 plus, the timeline is accelerating, the fundamentals are undeniable. This is paper to atoms. If this video opened your eyes to what's really happening in the precious metals market, do me a favor right now. Hit that subscribe button and smash the bell icon so you never miss an urgent update like this. The information I share on this channel could be the difference between protecting your wealth and losing everything to the paper market collapse. Like this video, if you're holding physical and you're not selling, share it with anyone you know who needs to understand what's coming. The mainstream media won't tell you this, your financial advisor won't tell you this, but I will every single day on Paper to Atoms. And here's a question for you. Leave it in the comments below. Have you tried to buy physical silver recently? What premiums are you seeing in your area? I read every single comment and I'll see you in the next update. Remember, get out of paper. Get into physical. Go, go, go.